Welcome back everyone to the Audacious Money Witch channel, where we talk about investing and trading and a lot of fun things. Jeremy Financial Education started talking about his number one stock he's buying, the Nike stock, 10 months ago, back when the Nike stock was at $109 a share. That's where he started buying.
Nike. NKE Nike, okay? I bought 50 shares as a starter position here. $5,400, first time I ever owned Nike in my life. They put up their numbers, they do their thing, phenomenal company. Number one stock I'm buying, just reported what's going on here, okay? So this particular stock I've been buying pretty aggressively here recently, and I've also been buying the stock very actively recently in the Patreon portfolio as well, and I do own it in another account, okay? It is Nike. So Nike stock, I'm up to 343 shares in the public account, $34,000+ in the stock, and this has been a stock I've been wanting to buy.
Today, Nike stock is trading at $75 a share after a dramatic 20% one-day crash, following Nike CEO confirming that things will likely get worse before they get better. That probably made Jeremy's private groupers and Patreons piss their pants. So what happened to Nike as a company, and more importantly, what can we learn from Jeremy's obvious 5-figure mistake? Of course, I will reveal exactly how much that he lost in Nike so far. Will I buy Nike stock now, or at what price will I start buying? I think Nike has a management problem and an innovation problem. Nike has been relying too much on trotting out old models and not coming up with new products as quickly as they once did. In other words, it's not as cool as before. Consumers are looking for newness and inspiration, but are not just shopping for shopping's sake. To buy the same old things, brands delivering on this are seeing success, but it is not a rising tide lifts all boats environment. Nike is a great example. I think Nike's current executives lack the instinct and experience that the prior team had, which left Nike in a push model situation, meaning a company has to try to convince consumers to buy its products rather than the opposite scenario where people are struggling to get their hands on companies' rad shoes and skirts. Nike CEO is under pressure to innovate as market cap falls by $28 billion. Nike said it expects revenue to decline in the mid-single digits this year, with revenues for the first half of the year down in the high single digits. In the first quarter, sales are expected to be down 10%. In contrast to the modest 2% growth Wall Street was expecting, a notably laggard was the Converse subsidiary, where revenue plummeted 18% due to soft sales in both North America and Europe. The inferior numbers, even worse than last quarter's, will tighten the vice around Nike CEO John Donahoe as he seeks to restore the company's culture of innovation, an ethos it will need as nimbler rivals like Deckers, Hoka, On Running, Alo, Viore, and Lululemon chip away at its market shares in the key running and apparel categories. Donahoe, a former management consultant who has led tech giants like eBay, but never a consumer products company, became Nike CEO in 2020 after joining the board a decade ago. He conceded this spring that Nike's innovation cadence had waned, pointing the finger at the rise of remote work. In recent years, Nike had shifted more of its focus from cutting-edge footwear for serious athletes to lifestyle clothing and shoes. Nike's executives blamed the slowdown in its most recent quarter in part on lifestyle brands including Air Force One and Dunk. The CEO admitted Nike has lost its sharp edge in sports and would have to reestablish its disruptive innovation pipeline. Many of Nike's recent problems have resulted from unforced errors made by Donahoe. In addition to the overemphasis on lifestyle products to the detriment of items focused on performance, the CEO made a major strategic error by exiting 1/3 of its retail partners in recent years and selling less merchandise to chains like Foot Locker, Macy's, and DSW, betting it could sell items more efficiently and profitably via its own stores and website. Donahoe was hired originally to turn Nike into something of a tech company, with e-commerce and apps at the center of its strategy. But ultimately, Nike can only succeed by turning out boundary-pushing products, something that is impossible to do immediately. A comeback at this scale takes time. CFO Matthew Friend warned. The light at the end of the tunnel for Nike may be further out than initially expected. If Donahoe fails to reignite Nike's innovation culture, its customers will continue to look elsewhere for that newness. At least 7 analysts tracked by Bloomberg have downgraded their ratings on Nike. Here are some comments from the analysts. Nike is a mess and is deflated, as is any confidence we may have had, said Williams trading analyst Sam Poser. The major problem is that the fiscal year 2025 guidance likely does not represent the worst case scenario. Nike is not as great a company today as it was prior to 2020, in our view, and does not appear to be heading in the right direction, despite management's claims to the contrary, Poser said. We remain unconvinced that Nike has the team in place to once again become a growth company. UBS analyst Jay Soul was also skeptical. Nike's Q4 report indicated its fundamental trends are much worse than we realized, Soul said. Our key conclusion is there will be no quick rebound for Nike's earnings. We believe Nike is embarking on what will be a multi-year reset of its business in order to return to healthy top-line growth rates. Despite persistent inflation and elevated borrowing costs, consumer spending, the main engine of the economy, has largely held up. But cracks are starting to emerge. Revenue decline is bad for any company. Is this a Nike-only problem, or we are already in a recession? Walgreens shares another Jeremy Financial Education's top dividend stock picks.
If you don't understand this company, I used to be an investor in this company. I used to work for this company. I've lost so much money in this stock, and this is supposed to be one of the most stable stocks in the stock market. Like, the reason you buy Walgreens is for stability usually. And now the company's trading at a forward P of like 5 or 6, which is just like mind-blowing. How I feel with Walgreens stock as well. It's like one of those that you're holding and it's like, this isn't even like really a safety stock anymore. Like, can it get any worse than this? Your CEO and your CFO just stepped down. It doesn't get any worse than that. Like, that's as bad as it gets. I mean, your CEO and CFO both stepping down within a month and a half of each other. Like, that's insanity crazy, okay, folks? So, yeah, I would lean toward buying over selling. I think we're at a point with Walgreens where it's probably max fear priced in. We'll see though. Okay, I'm down $6,400 on my shares now. Do keep in mind I've made a bunch of dividend money in this over time, so the number's not that bad. Maybe I'm down, I don't know, 3,000, 4,000, 5,000, something like that. But nonetheless, it still just has not treated me well.
Suffered their worst day since at least 1980 on Thursday after they slashed its profit forecast for the full year due to worsening retail environment. Walgreens said its shoppers have become increasingly selective and price sensitive in their purchases, which has led it to offer promotions that will dent profitability, and they would have to close significantly more stores. Jeremy just said that Nike has no competition. If that's the case, why is this stock down? I think everyone knows that Adidas has always been a strong competitor to Nike from the beginning. Adidas' new CEO, Bjorn, has sped up the introduction of new products like the Retro Samba sneaker, which has become a hit and fueled a new era of growth. Well, you can only buy Adidas on the OTC market, which is thinly traded. Not to worry, billionaire investors were scooping up shares of Lululemon recently. Ken Griffin of Citadel Advisors added 209,776 shares, increasing his position by 116%. And Jeff Yaz of Susquehanna purchased 144,704 shares, increasing his position by 111%. Jeremy loves to brag about how successful that he is. So how much loss does Jeremy sit on right now on his number one stock, Nike? From my calculation, it's up to a 5-figure loss. Just based on this video alone, showing his Nike share cost basis at $103 a share. And he has 343 shares, and with a total book cost at $35,472, I think this is probably on the light side since he has other accounts. I think his mistake is he likes to buy way too frequently.
Right here was my first buy in the public count here. This was December 28th, 2023, so right before New Year's. I bought 100 shares there, 5 shares, 10 shares, 185 shares I bought right here on January 17th, then 5 shares, 13 shares, 4 shares, 8 shares, 8 shares, 5 shares.
A professional investor or trader time the bottom, then makes the move. Dollar cost average or average down is a very dangerous game, which Jeremy loves to play. So be aware of that. Imagine you followed him buying at $103. Now you are almost 30% down. My Nike buy price is set to $69. If that's what you are waiting for, if you are still here, give me a likey for the sake of Nike. Jeremy is currently selling his 1000X Stocks website, which is a stock comparison tool. Well, I am using this tool for free. Let me show you a comparison between Nike stock and my Lululemon stock. Why Lululemon? They have better numbers, and that's a fact. They are the brand that is gaining customers and loyalty. Lulu stock is down nearly 40% in 2024. At the current price, it trades at a forward PE of less than 20, which makes Lululemon stock appear to be a bargain. Lulu has better gross and profit margin than Nike, with better PEG ratio and debt to equity ratio. Lulu is growing faster than Nike globally. Now that Nike is in decline, I could see a real chance Lulu can surpass Nike.